Greetings, one and all. Sorry, we just restarted the recording. As many of you know, I've written a New York Times best-selling book called Angel Investing, The Gust Guide to Making Money and Having Fun Investing in Startups, which is the result of my many years of being an angel investor and running an angel group and getting angel investments myself for my own ventures. And so what we're doing here, as Pete mentioned, is we are creating a live, real-world, real-time guide to being an angel investor. It's going to use the book as its textbook. It's going to use the Gust platform for all the things that we have, the deal flow that we get, the angel investors we have on the platform, and hopefully it's going to be an experience that will be the easiest on-ramp to angel investing ever invented, because it's going to have everything from content to community to deal flow and the like. So today is a sneak preview of the entire course wrapped down into one 45-minute session. And I'm going to go at lightning speed through the summary major areas we're going to be covering during the Angel Guide program to give you an idea of what angel investing is like. And if you are a founder who is raising money from angels, then this will show you behind the scenes what they're actually thinking and why they do the crazy things they do. If you are a potential angel investor yourself, this will give you an overview of the process of how you do it right. And it's not just randomly walking down the street and tossing out money or tossing darts at a dartboard. So the first question that anybody would ask is, why on earth would I want to do this? What is special about angel investing as opposed to other kinds of investing, like investing in the stock market or just putting my money in a bank account? Well, to do that, it would be helpful for us to take a look at the various kinds of returns, the comparative returns you can get from investing. So if you put your money in a bank account, well, historically, for the last 5 or 6 years, you were getting 1% or less. These days, maybe you're getting 2, 3, or 4% in there, but it's not a whole lot. Over time, if you put your money into the stock market, historically, the stock market averaged out over time, the highs, the lows, the goods, the bads, has returned steadily about a 5% per year return. But if you want more than that, and if you are, as we'll learn, an accredited investor, somebody who has the either financial wherewithal or the experience to get access to riskier investments that aren't as supervised, you can put your money into a hedge fund. And hedge funds typically try to return 10% or so. Bernie Madoff was returning 10%. How he got there is another story, but that's an indication of that's the goal that investors are trying to get from hedge funds. But what if you want more returns, you're willing to take more risk? Well, then you can go into private equity funds. And because hedge funds and the stock market are investing in publicly traded companies, private equity funds are money, you put your money into a fund with other people, and it's managed to invest in companies that aren't necessarily public. They're privately held companies, and there are a lot more privately held companies than there are public companies with a much wider range. And so therefore you have more potential for upside. And historically, therefore, private equity funds have returned on average over the long haul time about a 15% return. But what if you want even more and you're willing to go even earlier and riskier into this whole startup universe? Then you can invest in a venture capital fund, again, available only to accredited investors, people who have substantial amounts of cash and risk tolerance and the like. But if you invest in a venture capital fund, these VCs invest in the kind of companies you've heard about, the Apples and the Microsofts and the Amazons, before they are available in the public stock market. And what can you get by investing in a VC fund? Well, typically VC funds will target a 20% per annum return. You may not get that back until the very end of the fund when they distribute their interest in there. But if you hit some big winners, 20%. So if you can get 20% on your money by giving your money to a venture capitalist to invest for you, and then just sitting back and playing golf or taking a vacation while they do the work for you and get compensated for it, why would you ever want to try and invest your risky money directly into an even riskier startup? Well, the answer, as in the title of my book, is two things. And the first of them is making money, because it turns out that if you as an individual person invest in these early stage startup companies and you do it consistently and you do it intelligently and you know what you're doing, the average portfolio return can be over 25%. It's between 25 and 30% per annum on your money. And on top of that, it can be an enormous amount of fun. It can be fulfilling. It can do good things for society, all things that we'll talk about over the next half hour, 45 minutes or so. Okay. So you want to be an angel investor, you got some cash, you have the money to do it, you have the risk tolerance, you think you'd love to get that 25% return over there. So how do you do it? Well, there is a time-honed way of doing this. And so you go around, you peek in every garage you can find, and you look for some scruffy guys who look like this, and then you write them a check that looks like that. Yeah, a couple of guys with beards, see over there, around me. So you write them a check that looks like this. You wait for them to be seasoned and mature and grow up a little bit. And then hopefully the company that you invested turns into a company like this, which is worth a lot of money. And if you had invested the kind of $92,000 check that this guy over there, their angel investor named Mike Markula, gave them back in the day when Apple hit $3 trillion this past summer, the shares of stock that he got for his $92,000 check today would be worth $1 trillion. Just saying. So angel investing can be very lucrative. But even if you are not Apple Computer, there are lots and lots of other companies. In fact, every single major successful company that you have ever heard of has had one or more angel investors somewhere in the mix, typically right after the founders come in. And so all of these amazing companies, whether it's Apple or LinkedIn or Starbucks or Amazon or PayPal, Cisco, Google, you name it, they all had angel investors early on who made extraordinary amounts of money, and more than that, helped the company get started. So let's talk about where angel investing fits into the great scheme of things, right? And so this is a chart showing the life cycle of a company from a pure idea on the far left of the x-axis all the way to being wildly successful and profitable on the right. The y-axis is how much money is invested. And you'll note that this is not a linear graph. This is a logarithmic scale, which means that each of those numbers is 10 times the previous number, because numbers can get very big as a company gets very big. So where does the first money come from to start a company? The first equity when you are trading dollars for ownership of the company. And the answer is the very first equity comes from the founder. And if the founder does not put in his or her own money, you as an angel investor sure shouldn't put your money in as well. How could you ever want to rely on somebody who doesn't have the faith and belief in themselves to invest their own money in their own company? The interesting thing here, it doesn't matter how much they put in as long as it's meaningful. The amount you would expect from Elon Musk investing in a new startup of his to a kid with a paper route who was putting in all the $3,000 they earned over 10 years of a paper route would be very, very different. The important thing is that they have faith in themselves and put their own fungible money into their company. Okay, where does the next money come from for a startup? Well, the startup still hasn't gotten much off the ground. It hasn't made any money yet. It needs more money. So who is it that has faith or belief or something in this company? And typically the next cash after the founder's cash that comes in, these days is called a hustle round. Another way of traditionally saying that is the friends, family, fans, and fools round. And so these are people who are not sophisticated investors, venture capitalists, or even angel investors like you are going to be. Instead, these are people who either are madly in love with the idea, regardless of whether it's going to be a success, or they're madly in love with the founder, their friends, their relatives. They want to support the founder doing this. And so they are investing for reasons other than the straightforward economics of the deal. They are investing because of the founder or purely the idea. And after they have taken this risk in this very early stage, then the question is, who comes in next? Ta-da! That's where our fearsome, wonderful angel investors step in. Typically, after there's some traction, which we'll talk about, and angel investors are typically putting in the tens of thousands of dollars per angel investor per deal. There are some who can write bigger checks in the hundreds of thousands, but that's the range. And remember, this is a logarithmic scale. So tens of thousands to hundreds of thousands of dollars after a company has gotten itself started is where the angels play. Well, then what if the company is successful and needs even more cash? Well, then you go up the scale to get investments of equity into this company. And these are groups of angel investors. There are, believe it or not, organized groups of people who make these angel investments around the company. We love them. I founded one here in New York City called New York Angels. New York Angels has invested over $150 million into over 400 companies over the last 20 years since I founded it. And so this is a real source of cash. And so angel groups will typically invest in the hundreds of thousands of dollars to perhaps low millions, either singly as a group or with other groups together. This is also the place where you're going to find seed funds. Those are special venture capital funds, mostly started within the last 10 or 15 years, that deliberately target very, very early stage companies before traditional VCs come in. And you'll also find here accelerator programs. These are effectively seed funds with an attached program to help a startup get going, to help give them mentoring and access and sales channels and support and so on, and some cash along the way. So that's where these folks come in. And then only after a company has sort of gotten through those kinds of stages and has managed to get some real traction going and shown that it is a very, very good likelihood of success, albeit still risky, that's where you get the venture capital investors coming in. And the VCs will typically put in millions of dollars to tens of millions of dollars, conceivably even hundreds of millions of dollars at the very, very far end. But think of VCs as being in the millions to tens of millions. But then if the company going farther to the right is now profitable, growing rapidly, wildly successful, is clearly going to be the next Uber or the next Apple, then the investors can get open to a broader scale. And that's where you have what's called an IPO, or an initial public offering. And that's where regular, ordinary people who don't have to be accredited investors can invest by buying shares on the stock market. So in addition to this sequence of funding for early stage startup companies, there are other sources of funding as well. There are investments from strategic partners. There are grants that you can get from the government to help reduce the risk before angels come in. There are equity crowdfunding platforms and the like, but those aren't the ones we're going to be talking about during the next year of working with the Angel Guide program. Instead, we're going to be focused on these people who are putting in money, getting equity in the company, typically angels and organized groups of angels and accelerators and venture capitals. So the question is, venture capital over there in the purple on the top and angels in the pink there on salmon on the bottom. What's the difference between angels and VCs? If you talk to founders, they'll often call it one word: angels and VCs. I'm going to go raise money from VCs and angels. But in actuality, they're quite different. And that's because venture capitalists are professional money managers. These are people whose day job it is they get paid for managing other people's money. They raise a big pool of money from folks who have a lot of cash, for example, insurance companies or pension funds or university endowments or things like that. And they manage that money by investing it in potentially high growth kinds of companies. And they get paid for doing that. They get paid typically a percentage of the fee of the annual of the fund every year to cover their salaries, while at the same time getting 20% of all the benefits when the company becomes a major success. In contrast, angel investors, that's us, that's you, are what I call rich-ish people. Now, rich people, you think about Jeff Bezos or Elon Musk and so on. You know what? Jeff Bezos and Elon Musk and Bill Gates don't go around making angel investments, because if you have $50 billion or $100 billion, you don't have the time to go take a little 25K piece of that and invest that into a poor startup. So instead, when I say rich-ish people, angel investors are people who have money that they've already gotten, they're taking care of their nest egg, they've taken care of their kids, they bought a house, and they have some extra money for which they're willing to go out on a limb and take a risk and hopefully get a big return on that. But because this stuff is risky and angel investing is very risky, the government wants to be sure, trying to protect you, that people who shouldn't be doing this don't do this. And so that's why the one and only governmental regulation about this, about angel investing, says that if you want to be an angel investor and invest equity, buy shares of stock into somebody's company, the only way they can sell it to you is if you are what's called an accredited investor. The definition of an accredited investor means a person, is defined by the SEC, by the way, the Securities and Exchange Commission, means that you are a person who either has a steady annual income of at least $200,000 a year, $300,000 if you file jointly with your spouse, or you have net investable assets, which means not including the value of your home, of at least $1 million. So you're at least a millionaire in terms of disposable assets. Or the latest change for this a year ago is that if you are sophisticated, even if you're not rich or have a giant income, if you are registered with the SEC and have passed either your Series 7, 65, or 82, these are securities brokers and salespeople's licenses, they figure you know enough about business and investments to be able to do that. So that's the only legal regulation. Now, if you qualify as an accredited investor, and by the way, if you don't, there really is no way around it. You either are or you're not. It's binary. But then on top of that, there are a bunch of pragmatic things that you need to qualify to be an angel investor that we think are really important. I've been investing for what, 30 years now, more than that, 40 years. We've been with Gust working for 20 years with angels around the world. And here's what we have figured out, that if you're going to be an angel investor, you better have a long-term view. This is not short-term get rich quick. This is not a cryptocurrency where it can go up 500% in one day and you can cash out. This is not something that is liquid. It's completely illiquid. You have to be prepared to put your money in and then forget all about it effectively. The average holding time is a long period of time to foresee the profits from your angel investing. So if you don't have a long-term view, if you can't afford to take that money and set it aside and forget about it for a decade, then don't be an angel investor. Number one. Number two, the other part of that is you have to have the ability to lose all that money. This stuff is very risky. And the fact is, no matter how wonderful the founders, most angel investments actually fail. You lose your money. So if you don't have the ability, either the economic ability to tolerate the losses or the internal psychic ability to do that, then you shouldn't be investing as an angel. Likewise, you need to have a very high tolerance for risk, because definitionally, an angel-backed company is starting out of nowhere. It's losing money. It's doing something that nobody else has ever done. Otherwise, you wouldn't have the kind of high growth potential over there. And when you're walking that tightrope, that high wire, with a founder who may be a first-time founder, the odds are that it's going to fail. And if you're one of those type A personalities who can never fail because you're too good for this kind of stuff, believe me, you will lose years off your life by being an angel. So don't do that. The flip side of that, or the explanation of that, is you better have an even temperament, right? Because angel investing, more than anything else, it's the craziest world out there. One day it looks like it'll be great. A customer is going to pay you $1 billion. The next day the customer goes bankrupt and your competition out there, whatever. So you have to be able to take this stuff in stride. You're going to be working with people to get a company to take your money. It's not just who has the most money, because founders get to choose. If they have a good company and more than one option for investors, they can choose who they want. So you better have good people skills to work with these founders over time. You'll see as we go through the economics of this stuff that you're going to have to make a lot of bets as an angel investor if you want to get those returns we were talking about. And that means you need to have the self-discipline to invest, even if your last investment failed, to invest again. And even if you think something is going to be a killer guaranteed success, you only are going to invest the amount that you have previously decided to invest across all of your investments. You're not going to differentiate putting more into the good ones and less into the bad ones, because they're all risky. You better be willing to learn. A great step is starting with Angel Guide, because we're going to spend the next year with you in a 3-week intensive, followed by a lot of handholding for the rest of the year. And so you'll learn, and you'll learn by doing, and you'll learn from other angels, and you'll learn from founders over time, right? And then finally, we love entrepreneurs. We are one. I mean, I am. When my tombstone will say, "Here lies David S. Rose, entrepreneur." Oh yeah, he was also an investor and blah, 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 blah. But entrepreneurs, you have to love entrepreneurs, because entrepreneurs are these crazy people. They think different. To quote the Apple ad, they are irrational, crazy, passionate, driven people who don't always follow the same playbook as everyone else, and you have to really love them. So that's the background about what angel investing is and who should be in it. So now let's go into the details, right? What are the fundamentals of angel investing? What does it actually mean to be an angel, and how does this whole thing work? And there's a very simple thing you should keep in mind from the very beginning. And here is what the fundamentals of angel investing are. And that is, as an investor, you will develop a thesis. You will say, I am investing because I think I know X, or I believe that this type of business is going to get bigger than other types of business. And so you have a thesis as to what you're going to invest in. You don't just blindly sit there, responsive to people coming and pitching you. It's not like you're the king and supplicants come up and say, oh, please, and you just toss out money. You have to know what you want to do. That's what differentiates the angels who get those 25% returns from the ones who lose it all. You have to go in knowing what you want to do. And when the founder comes to you and says, here's what I've got, they're going to pitch you. That's what a pitch deck is. They're going to, throw the softball at you, and you better catch it. They're going to say, here's what my business is all about. And their job, as we tell them, is to make it very clear what their business is, not to gussy it up, not to pull the wool over your eyes, not to con you into doing something. Their goal is to tell you exactly what they've got. And so therefore, with those two fundamentals, you get to the next one. their venture, what they are doing, fits your thesis or it doesn't. And the answer is if what they're doing does fit your thesis for location and quality and business and all that kind of stuff, financials, then you want to invest in it. You both need each other. You need to have that kind of hot company to invest in. They need your money to grow. If it doesn't fit your thesis, whatever your thesis is, then move on. You pass gently, let them down nicely, you tell them it's not for you, and you move on to look at the next one. And typically, angels will look at 40 deals before they will find one in which to invest. So, okay, when you're looking at deals, when you're creating a thesis, what is your thesis? Well, I'm going to start out by telling you what your thesis isn't. And it may surprise you because this is what you may think that all angels' thesis is. Oh, angels invest in these really cool new ideas. You know what? No, wrong. Angels don't look for ideas, cool or otherwise, because it turns out that ideas are only a multiplier of value. You can have a really great idea or really awful idea, but they are just a multiplier of execution. And that's where the value comes into play. So basically, you could take a so-so idea, but a so-so idea executed brilliantly could be worth $50 million. And you can have the world's most brilliant idea and just sit there with that idea in your pocket and it's worth 20 bucks, right? If that. So therefore, you're not investing in ideas, you're investing in execution or the ability to execute. Okay, with that out of the way, you're not looking for ideas. What are you looking for? Well, how do you build your thesis? And typically, all angels start with three fundamental basic theses. And the first thesis is investing in great people. We call this betting the jockey, not the horse. And every investor I know would prefer to invest in a grade A entrepreneur, a grade A founder with a business plan that's okay, as opposed to the world's most brilliant business plan with a class B founder, because it all comes down to people. And when you're looking at the founding team, when you're hearing that pitch and you're going through their deck, you're looking to see who is it that you're going to be investing in. And the interesting thing is, this too may not flow out exactly as you predict, because even though most of what we invest in these days are technical businesses or technically facilitated businesses, the person you're investing in is not going to be the techie. And it's not even going to be the UX designer, the user experience designer, or the user interface designer who makes the product look really gorgeous over there. You'd say, well, who am I investing in? How about the guy who brings in the money, the salesperson? Nope. You're not investing in the salesperson either, because they're an important part of this operation, but that's not the key thing. Oh, okay. Well, then it must be the business, right? You want somebody who understands business and can make sure that we pay our taxes and do everything out there. But you know what? Not the business person either. So you're asking me, well, who the hell am I investing in then if it's not the tech designer or the business salesperson, business person? And the answer is what you were looking for as an angel. What I, in my book, in chapter 4 of the book, capital T, capital E, I call the entrepreneur. The entrepreneur, the founder, is this special breed of person who you are betting everything on to make you a whole lot of money. And the entrepreneur can be any one of those things. If you cross an entrepreneur with a techie, you know who you get? You get Bill Gates. I mean, Bill Gates had 10,000 hours of programming, before he started Microsoft. You cross a user experience person with an entrepreneur, you get Steve Jobs. That was his whole thing. You cross a salesperson with an entrepreneur, you get Mark Cuban. How about a green eye shade business person? Well, cross it with an entrepreneur and you get Mike Bloomberg. Hello, all of those billionaires. And it wasn't the fact that they were tech or design or sales or business. It was the fact that they were entrepreneurs. So you're looking for this extraordinary entrepreneur, and we will discuss how you identify those traits and what you look for in those traits. Number two, the second thing you're looking for as a basis for your thesis, your fundamental thesis, is scalability. And this is really important. Scalability means you're looking for businesses that can start very, very small, that can be proven with a little bit of investment, hopefully one that the founder had put in before you're coming along, and show that if they put in $1, they can get back $2, right? Because then if that works and if the business itself is inherently scalable, if they put in $1 and get back 2, you can put in $10,000 and get back $20,000, right? So therefore, the goal, and it's even more so when it's your money, because now you want to prove with the cash that you're putting in that you can put in $10,000 and they can get back $20,000. Because then, if it's appropriately scalable business, you can put in $2 billion and get back, 10x on that, right? So the first part of scalability is you can do the same thing small and then watch it grow by just providing it with more feedstock, with more cash over time. But the second thing about a scalable business is that as it gets bigger, it actually gets better. And it gets better either because of economies of scale or the network effect or other kinds of things. So, for example, if I asked you tomorrow morning to go create a website to sell a copy of my book, you could do it. There are tools out there and platforms, but the cost to you to actually spin up that site to sell one copy of my book would be more than you would get from selling that book. On the other hand, if I asked Jeff Bezos, the marginal cost for Jeff Bezos to sell one copy of my book is somewhere between 0 and 0, right? And so that's what a scalable business is. The third fundamental item, 3 out of 3, the third fundamental thesis that angel investors have is this magic word traction. And this is a word that founders hate and entrepreneurs and funders love, because this gets down to execution. And so execution, remember, is where all the money is, and traction shows that they have executed. But what's interesting and what causes a lot of problems when you're an angel investor is the realization that what founders think of traction and what investors think of traction are typically different things. So founders typically think of traction as, oh, I've got the world's greatest idea, or I've hired a whole team, or I've got these amazing advisors on in my pitch deck. Hey, I filed for a patent and my patent's been issued over here. Oh, look at this. I built the MVP, minimum viable product of my product. Hey, wait, I've got a business plan, a 30-page business plan shows exactly how I'm going to make doing this. Oh, I've taken out ads. I've gotten lots of wonderful press coverage. I've gotten Google 1,000 people on my waiting list from Google AdWords. I've raised, $5 million from my combinator. None of this is traction. This is all great stuff. Like to have all this kind of stuff, but none of this counts as traction that you as an investor want to see. Instead, what you want is this definition of traction. Traction is something outside the founder's control. That's critically important. All the things on that previous slide were within the founder's control. But traction has to be outside the founder's control, and it shows that they have actually created value for somebody, not them, and that the value that they're creating is getting bigger every day. So what is the best demonstration of traction? It's not an MVP. It's not people on your waiting list. It is, surprise, surprise, paying customers. Actually, profitable paying customers would be the best form of traction, because it makes the through line happen. It shows that they're making something that somebody wants, that somebody's willing to pay for, and what they're paying for is more than it costs the founder to make. So that's great. That validates the whole business that they're in, right? So you're looking for traction. And if you don't have traction, you got to step it back. Well, if they don't have paying customers, or profitable customers, do they at least have paying customers? If they don't have paying customers, do they at least have pilots that could turn into paying customers? If they don't have pilots, do they have beta customers? So you walk it back to whatever level of comfort you have with traction, but you're looking for traction. So those basic things, not investing in ideas, investing in people, scalability, and traction, are common across all angels. What comes next? Well, this is where you get to decide what kind of angel you want to be, because this is where you begin to develop your own thesis. And this is when we'll be talking about this over the next 3 weeks in detail. And the next year will be a sounding board. We'll talk about developments in the world, industries in which you have expertise over here. And so typically angels, when they create their thesis, their investing thesis, they're looking at things like location. Historically, angels only invested in their own city, where they could go over and knock on the founder's door, a couple times a month and say, hey, how's it going? And they could sit in on board meetings and stuff. Well, you know what? We're an increasingly decentralized world. And so typically now angels tend to invest regionally, their own city, their own state, their own part of the country. But some angels say, hey, no, I'll invest in Sweden. I'll invest in Ghana if there's a really interesting, appropriate company there for what I want to do. So you got to decide what's your comfort level with where you're going to invest. The next up is the question of stage. The earlier the stage in which you invest, the riskier it is. The riskier it is, hopefully, if things work out right, the bigger return you get. So you have to personally decide your own risk return ratio and decide how early you want to go. If you want to be the first professional check writer in there after the friends, family, fans, and fools, then and you're taking a risk that nobody else in the whole world has decided is worth taking, okay, you get a lot of points for that, and you get some control, and you get hopefully a big return, but it's very, very risky. On the other hand, you can say, you know what, this is very nice, but I'm a later stage investor. I'm going to invest at the Series B stage, and when the company's already up and successful and growing fast, and I just want to add fuel to the fire to it, and I'm willing to pay a higher valuation. In other words, get much less for my money, an ownership of the company for my money, but it's going to be a lot safer because it's already shown that out there. Then, and a really important thing that applies to most angels is what sector are you looking to invest in? And typically, you don't want to invest in something you don't know anything about because that's the easiest way to lose all your money. The areas that you know something about, you can actually make a rational judgment and decision about whether to invest, and you can be helpful to other investors by providing your expertise to them over time. So, for example, if you are an expert in manufacturing, you might want to look at manufacturing or robotics or other kinds of companies. In my case, I don't invest in entertainment deals. I'm not a gamer. I don't invest in fashion deals. I have zero fashion sense. I don't invest in alcohol or beverage or food deals. I don't invest in fat deals. There's a whole lot of stuff I don't invest in. I invest in a very few areas that I actually know something about and can really be a value adding angel. Another thing that many angels who are new don't often think about is the question of business model. What is business model? Well, if you're doing a product or a service, the question is who is buying it and how do you get paid, right? So, for example, what we call a B2B model is a business to business model in which you as a business are selling your product or services to other businesses, not to the end user. A B2C model is business to consumer, where you are selling directly to the end users, Harry's razors or whatever it is, right? Amazon in their online shopping business is B2C. But you can also have a B2B to C business where you work through businesses on the one hand, and then you actually have end user customers on the other hand. And there are other things. So that's the type of customer you have. And then there are some businesses that make money by marking up their costs. There are other businesses that make money on a subscription basis. There are businesses that make money by taking a marketplace transaction fee or a percentage of things. There are all kinds of different business models, and some people are more familiar with some than others or more knowledgeable and will only invest in those kinds of businesses. A marketplace business, for example, where buyers and sellers come to trade, as opposed to a retail business where you are deciding what your customers want and then selling it to them. After that comes size. Okay. I mean, how much of a check do you want to write? If you're very well heeled and you want to jump in with both feet, you could say, hey, my check size is going to be $50,000 or $500,000 into every company I write. Well, you can put in $500,000 checks if you have, $500 million or whatever, a lot of money out there. But if you don't, you might want to restrict the size of the check you write. Probably the smallest check you can reasonably write as a single angel investor into a company is probably $5,000 per company. The average check size for the average angel who belongs to an average angel group in America is about $25,000 per company, per check. So you write in a particular round, you write a check for $25,000 into that company. You may invest more later on, but that's the typical check size. And then one big question, which will determine very much together with stage and check size, what you can invest in is, are you ready to be a lead investor or not? Are you ready to be the first person to make the decision, I'll write a check, even though nobody else has written a check yet? And even though we don't know, I'm going to have to decide the valuation I'm willing to write the check on with the founder. I'm going to have to decide the terms. I'm going to see if I can get other investors in, unless I can write the whole check myself. So being a lead investor is insanely valuable to the entrepreneur, but can be really challenging for the investor and is something that is difficult to do if you're just starting out. But hopefully, spend a year with Gust Guide and we'll walk through a bunch of investments. You'll be on different diligence teams. You'll work with different companies. And at the end, you may decide to say that, hell, okay, I think I can lead a deal because I'm knowledgeable enough about it. So ultimately, if you look at the first three things that I mentioned, in terms of people and scalability and traction, and then you add in your special flavor of your own thesis over here, that's going to end up cutting out the vast majority of people who approach you. That will probably rule out 95% of all of the deals that come to see you. And so instead of taking the time and, oh, say, I don't look at this kind of deal, you basically have to say, okay, sorry, doesn't fit my thesis. Not even worth taking the meeting, because you don't care how good it is. If it doesn't fit your thesis, you're not going to invest. Or alternatively, change your thesis. If what you've seen says, I had an epiphany, and you know what? Forget where I was going. This is what I want to invest in. Whatever that is, then you have to fundamentally tell yourself you're changing your thesis, and everything you invest in the future is going to be in line with that thesis. All right. You've now decided what it is you want to invest in. So how do you find those deals? You just sit back and like a mother sparrow comes along and sticks it down your throat? No, you typically have to either go out looking for it or put yourself in a position where that deal flow comes by. And so typically there are a whole lot of ways. If you're just starting out and you've never been an angel before and you don't know how to be an angel, you won't see any deals. It's like there's a whole unseen dark web out there of deals that are floating by you that you'll never see. But once you actually become an investor and know where to look, and people know that you are investing, you will find it's like, one of those Pokemon things where all of a sudden you've got augmented reality and you'll see all the stuff that was floating there that you didn't see. I mean, so somebody like me, who's known as an angel investor, I probably get 5 to 10 deals directly to me every day. People saying, hey, I want to show you this deal or whatever. Right. So here are some of the major ways that you can find deals. And by the way, everything I'm discussing in the talk today turns into effectively a full class that we'll be doing over the next 3 weeks in detail. So some ways you can find stuff. Angel groups, joining a group of angel investors is a wonderful way, because angel groups say, hey, we're a group, we're looking to invest in new deals, and investor and founders come to them. Our group, New York Angels in New York, gets between 150 and 200 new deals every month of people coming to us saying they want us to invest. Once you get known as somebody who's making investments, your personal networks can be great places. I mean, I am the only angel investor in my family, but I've gotten deals from my mother, my barber, friends or whatever it is, who know that I'm investing. When you go to business plan competitions, these used to be academic things in school, but now pitch competitions, as they're typically referred to, are all over the place. And you can see companies that are pitching, looking for money or telling you what they're doing. Accelerators, these programs that help for 3 months get a company started and going, will often have what's called a demo day at the end of their program, where all the companies will pitch to invited guests, and you can often join those things online. Every university today has an entrepreneurship program and accelerators and entrepreneurship centers. They often have demo days and events for their alums and others in the ecosystem who want to come in and do it. Industry trade shows, you'll see, brand new companies on the outer edges of the trade show. They will often have new ventures or pitch days themselves. Meetups and community events, the New York Tech Meetup, where I found one of my greatest deals of all time, a company called Jump Bikes. I wrote about in the book, Angel Investing. It was called originally Social Bicycles, changed the name to Jump Bikes, and eventually got acquired by Uber and became the back end of Uber Bikes. And I saw that at a New York Tech Meetup, and where they were showing off, and I thought that was really cool. And once you get into the position of being an angel investor and you're dealing with other founders and they see that you're invested in them and you've been a good angel, they will likely refer people they know. And founders often spend a lot of time with other founders. They have their ears to the ground. They talk amongst each other. And if you get a good reputation, you can find a bunch of good founders being introduced to you by other founders. Some of the last 2 or 3 deals that I've made, I have been introduced by other founders in my network, which is really great. There are startup conferences. There used to be a whole lot. There are now a number of big ones. Things like Collision and web conferences and all kinds of things where they are designed to bring together startups to pitch investors. And one of the nice advantages there is you can go out to a conference and see 200 companies in one day, just go up and down like a trade show looking at startups, and other ones are geared to particular industries. And then finally, last but not least, there are online platforms, and you happen to be on the #1 online platform for the angel industry, which is Gust. And to put things in perspective, at Gust, we get between 5,000 and 10,000 1,000 companies coming on every month onto the Gust platform and creating full profiles designed for investors about what they're doing. And we're going to be working over the next year with the folks in Angel Guide to help share appropriate deal flow from the stuff that we're getting. So there'll be lots of chances to find lots of companies. So now that you've decided what you're looking for, and now you know where you can get these deals, now you have to figure out what approach you're taking. And this is where things get really interesting because there are two major schools of thought here, the West Coast and the East Coast. It's the unicorn hunt versus playing Moneyball over here. And the unicorn hunt is typically a West Coast phenomenon here. And when you see things like Silicon Valley on TV or stuff like that, what you're looking at there are these unicorn investors. And Eileen Lee coined the term unicorn, meaning a high growth company with a greater than $1 billion exit. You now have decacorns, which have a $10 billion exit. But to put things in perspective, to pick a random year of 2014, there were 3.2 million companies started in the US and only 32 unicorns. So if you want odds of 100,000 to 1 about finding a unicorn, that's an approach. But there is a method behind the madness, because here is how West Coast Silicon Valley investors think about unicorns. They think, okay, well, the typical proto unicorn was Uber, right? So Uber started in 2009, and it went public in 10 years at $82 billion. And they think, if I had invested in Uber at a $1 million valuation, boy, would I have done well. But I could have invested in a 10 million valuation at an 82 billion IPO. I would have done very well. At 100 million, I'd still have made bank. At $1 billion valuation, it goes out at 82 billion. That would be an amazing deal. And you know what? Even if I had invested in Uber at a $10 billion valuation, I would still have made more than 8 times my money when IPO. And so therefore, the only logical conclusion of that is nothing else matters except that I have to be in the next Uber. Because if I'm the next Uber, all the other things about structure and valuation and everything else don't matter. Because if the company fails, it will have made no difference on what terms I invested, right? Because the money will be gone. But on the other hand, if it's an Uber-like unicorn, which I'm hoping for, it doesn't make any difference about what terms I invest in or valuation or anything else, because I will have made a fortune. Therefore, the only thing required is I figure out some guy with a magic touch who I can draft along behind. And when he or she figures out what a unicorn is, they'll let me in on the deal. And that's sort of the thesis behind AngelList and some other stuff out there. That's a very West Coast approach. It's all or nothing, moonshot or go home, prepared to lose everything, but you got to find somebody to get you in on those unicorn deals. That's not what my book is all about. Instead, my book is all about documenting and is the documentation for what I call the everyone else approach, or Moneyball of angel investing. And here, instead of aiming only for unicorns, although we would love unicorns and hope we get them, we're aiming here at least at gazelles. And this was coined by David Birch, and a gazelle, a high growth company that is increasing its revenues by at least 20% annually for 4 years or more after they hit a revenue of $1 million. So this is a solidly growing company. And in that same year that there were only 32 unicorns, there were 150,000 gazelles out there. That gives you a lot more shots on goal, as it were, to try and get a return on your investment. And so hopefully you look for the higher end of these. You'll look for ones that are closer and closer to being a unicorn. But you want to still be able to make money even if you don't get to be a unicorn, because making money is where the really important stuff happens. And making money is very opaque. And if you ask investors, if you ask founders, how do angels make their money and how do they decide on your valuation? They will say, I'm not quite sure. Because there is a secret to this. And this is a secret that you have to understand in your gut and in your heart day one, because it's based on the real world. So let's make some assumptions. Let's say you're a rich-ish person. You've got $10 million in investable assets. You are willing to, of that, put 10% or $1 million aside for angel investing over there. You never want to invest more than 10% of your worth in angel stuff, because it's very, very risky. Did I mention that? You don't want to distribute it over a number of deals. So let's say with your $1 million, you distribute it over 10 deals. And so now let's say that you will be perfectly comfortable getting just that typical return that professional serious angels got that I mentioned before, that 25%. And let's 25% per year. And let's say that you think, well, venture capital funds typically have a 10-year life. They'll spend 5 years investing and 5 years harvesting, so that they expect to be in a company for about 5 years. I'm coming in before a VC, so let's add another year on that. So let's say 6 years. So let's say that I want to be able to get that 25% return every year for 6 years before an exit, right? So doing the math, and this is really is about as hard as the math gets. That's 1.25, 25% extra to the power of 6, because you got to get that every year, including the profit from the previous year, right? So 1.25 to the power of 6 for 6 years means that's what the 25% is called, the IRR, or internal rate of return. The 3.8x is the ROI, or return on investment. And that means that for every dollar you put in at the end of 6 years, you want to get $3.80 out the other end. Okay. Now that sounds rational, doesn't sound crazy, sounds doable. And that's the way founders look at what you're trying to do. Okay, I think I can get you, 3.8 times your money in this business. I've got real faith in my business. The problem that angels very quickly realize is the math gets a lot worse than that. And why is that? Because here's what happens in the real world. Of those 10 investments you make, 5 of them will fail. Did I mention angel investing is very risky? Very, very risky. 5 are going to fail completely and take all your money with them. But luckily, 5 are not going to fail. So of those remaining 5, well, 2 of them are going to return just the money that you have in, right? 2 of them are going to return, whether somebody comes and buys their machinery or their patents, or it's an acqui-hire and they just hire the people and you get your money back. So on 2 of them, you get your money back even. Well, luckily, that leaves at least 3 companies left. And so of the remaining companies, 2 of them are actually going to be successful, very successful, and they'll give you back double or triple your money. Well, that's really good. Okay, so you can take that all day if you can get it. Unfortunately, it's only 2 or 3 companies out of your 10. So now let us take a minute to stop and review the bidding. You've allocated your $1 million across these 10 companies, and here are the results. 5 of them return 0, 2 of them return 1, 2 of them return 3. Now remember that each of them you put in 1/10 of your investment. So you put in this case, for example, $100,000 here across 10 deals, and you multiply that out. Okay, 1/10 of your portfolio times the 5 return is 0. All the way up to 2 times 3 is 6 times 1/10, because it's only 1/10 of your portfolio. That's 0.6. You add all those up and subtract them from where you want to be, right? Which was that 3.8. I got a problem here. I've just been through 9 of my 10 companies, and I was looking for 3.8 return on my money. And I still have to find 3 times my money. Well, yeah, you still got to find 3 times your money on your entire portfolio, but from only one of your 10 companies, which means, do the math with me, ta-da, that one company has to return 30 times your investment, not 3, 30. And what that means is the value of that company has to, because you're buying a percentage of the company for your investment, has to be, when you sell the company and you get a return, 30 times as much. So putting things in perspective, let's just give you a quick, rough foreshadowing of the economics here. Let's say you invest $1 million, you and your fellow angels invest $1 million in a company, and you all agree with the founder that the company is currently worth $9 million. So you're putting in $1 million. Now the company, after your investment, is worth $10 million, and you will have put in 1 million of that 10, or 1/10. So you now own 1/10 of the company, and the company is worth $10 million after your investment. Well, in order for you to get your return you're looking for, that company has to be worth 30 times 10 million, or $300 million without raising another penny, in order for you to get your 30x return. And that's why investors tend to be so hard-assed, and that's why investing tends to be so risky. And that is why you need to build a portfolio. Nobody ever just invests in one deal. And it's not because you can't eat more than one peanut or whatever it is. It's because you have to take multiple shots on goal. This is what's known as a Monte Carlo analysis done by Simsonov. It's really good. And this basically shows the odds of a return by the size of your portfolio. And so the red line shows a portfolio of 5 different companies. And the y-axis here is the probability, and the x-axis is the cash on cash return. And so what this shows is the 50% probability of that five company portfolio, is, that's about a 1 and change percent. You'll get your money back. If you want to get close to that 3.8 we were talking about, you better be up with a portfolio that looks like 100 over there, because it turns out, and actually 80, if you want to be exact, is the regression to the mean. But so if you have a portfolio of 80 companies or more, the odds are that you will end up with a greater than 3x return on your portfolio investment over time. And so most angels don't have a portfolio of over 100 companies. I do, but I've known this a very long time. So we suggest that you should be prepared at an absolute minimum to invest in at least 10 companies. Most angels will typically invest in about 20. Angels who are doing this really seriously and doing this over time with a whole thesis may go up to 30. So 30 should be sort of your target, with 20 your fallback. And if you can only do 10, let's talk. But below that, angel investing is not right for you. Okay, so you've now found all these companies out there. You've decided to know what your thesis is. You know what you're looking for. And now you got to do your due diligence. When it comes to investing, what is due diligence? Due diligence is where you are providing a due, meaning appropriate, and diligence means you're working hard at looking at the company to understand, effectively what you're doing. You're just saying, is everything the founder told me true? Right? Because the founder gave you this whole pitch of this wonderful thing, and you looked at that and you saw the projection, you said, whoa, according to them, I can make my 30x return, and this company is, absolutely foolproof, fail safe. So what are you looking at in diligence? Well, there are 3 kinds of diligence, right? First one is market due diligence. And this is, they're claiming the market for their product or service is so big, and here's what the competition looks like. Here's where the industry is going. And you want to make sure that that's all right. So you're going to call up look at their competitors' websites, and, call up research reports on the industry and so on and so forth. Next is business diligence. And this is where you find out, is everything that they told me about their company true, right? Do the products do what they say? I want to try the products. Are their customers really happy? Do they really have customers? Let me talk to your customers over there, right? Let me do a background check on the founder to make sure he's not a convicted felon or whatever, right? So this is where you do due diligence on the business. And then finally, there's legal due diligence. And this is all the stuff, okay, is the company legally, when I'm putting in my money into a company, is there a company, or am I just writing a check to this guy's personal bank account? Are they appropriately incorporated? Did they follow all their rules? Have they followed all their things? Do they owe back taxes? Do they have contracts that they actually say they have? Do they own their intellectual property, their patents and trademarks and so on, et cetera, et cetera, et cetera? And lawyers and others can help you with that. But these are all the things we look at to decide whether to invest in a company. And then if it passes due diligence and meets our theses, and we like the founder, everything else, then we've got to negotiate a valuation. And this is going to be based on getting that 30x return. So the question is going to be where I think this is going to go. I got to backtrack, divide by 30, and other funding rounds they're going to get to figure out what it's going to be. And the problem is that when you invest in startups, there is the dreaded J curve. And the J curve, named after the shape the curve takes, basically says the minute you put your money into a company, you start losing value because the company is losing money. And it's using your money that you put in to pay their debts and pay their suppliers and pay for stuff in there, right? So it's losing money, not making it. And you are hoping that eventually it comes up and makes enough money to break even, and then makes a profit, and eventually you can sell it. And this also works on the portfolio side as well, because when companies die, they tend to die pretty quickly. So if you invest in 10 companies, within 2 or 3 years, or 4 years, you may find that half your companies have died dead, and your portfolio value has dropped all the way down. Whereas the one company that may just be your home run may take you 10 years to get out there, right? So having decided the valuation, now how do you put your money in? What do you use in terms of documentation and paperwork? Are there standards? You bet there are. There are all kinds of standards. And you have all kinds of choices when you decide how you're going to invest in a company. And again, we're going to devote an entire session to this and going over it in detail. But to give you some dramatic foreshadowing here, you could give the company a loan and say, hey, here's a loan, and pay me back when you're successful. The only problem with that is the company may fail, first of all, and what would you get back? You get back the loan plus interest, and that interest is certainly not going to cover the risk of the company failing, so forget that. Okay, then go the other way. How about equity? Hey, here's some money. I want to buy shares of stock in your company. So when the company gets really big, I will have shares of stock, and that's called common stock. And that would be fine if the company gets really big. But what happens if you invested, we say, it at a $10 million valuation? You put in $1 million at a $10 million valuation, you get 10% of the company, right? But then the company doesn't do that well. It's not a total failure, but it gets sold for $5 million instead of $10 million. Well, what happens to that $5 million? If you have 10% of it, you only get $500,000 back. And the founder who took that company and took your 10 million and made it five gets $4.5 million back. Does that seem fair to you as an angel? No, it doesn't. Okay, so what do we do? Well, then we can try what's called a convertible note. A convertible note is a loan. So it comes out first if there's money to be had there. But if it's when it becomes a big thing, a big company, it converts to stock. And basically, a convertible note says, I want to invest in a valuation, but I don't want to do all the details. And maybe I'm not a sophisticated investor yet. I'll wait for a venture capital fund to come in after me. And so I'll give you a loan now, but we'll all agree that it will convert into whatever the next guy gets, whatever the big VC gets with all their fancy lawyers who are negotiating that. And so we do a lot of investments on convertible notes. But a few years ago, Y Combinator, one of those great accelerator programs, had a lot of hotshot companies that thought they were the cat's pajamas, and a lot of people, investors who wanted to get in there. So they created something new, like a new oobleck, and that's called a SAFE. SAFE stands for a simple agreement for future equity, and it's just like a convertible note, except it's not a note. It's not a loan. So therefore, it doesn't necessarily get paid back. It doesn't have maturity date. It doesn't have protections for the investors. And so that's great for a company if they have all the power, and you really have to be in it. But many investors will not invest in safes. I typically, personally, do not invest in a safe note. So what do I invest in, and what do all VCs invest in? Typically something called a convertible preferred stock. And so this is stock that sort of functions like a convertible note. This is, you're getting stock, and if the company ends up with a not great exit, you get all your money back plus dividends before the founder gets anything, which sounds about fair because your money is fungible. But if really good things happen, it becomes a unicorn, you can presto changeo, turn it into common stock and get your share of the upside. That's good. All right, you've now put in your money, decided what the valuation is. You've gotten your documentation in there. Now you're in the company and you want to add value. How do you add value? Well, there are sort of two sets of values. One, you want to do things that any friend of the company would do as an investor. You want to refer them new customers. If you see things about other things in the industry, you want to go and share that with the company to make sure that they know about it. Suggest new ideas. Tell them, make them aware of their competitors, right? Upvote their posts on LinkedIn and Twitter. You want to give moral support to the entrepreneur. This is sort of table stakes. Everybody who's a friend of the company is expected to do that. But if you're going to be a really valuable, value-adding angel investor who you want people to recommend you to other companies as an angel investor, there's more that you want to do, right? Well, first of all, you want to maintain some what we call dry powder, some additional cash, so you aren't totally tapped out in the first round. So if the company is doing well, you can invest in a follow-on round. You want to be able to introduce people in your network, other investors, strategic partners, and the like. If they come to you for consulting, if you know about their industry, because you're a value-adding mentoring angel, you can share insights about the industry. You can help them facilitate meetings. I just did that one this morning with one of my teams, where I helped mediate among all members of the founding team. You can serve as a coach or a mentor to the CEO. In some cases, if you're the lead investor, they might ask you to serve on the board. This is not an ego thing. This is not a money thing. You don't get paid extra for it. It requires a lot of psychic energy and time and effort, but it can be really useful to the company if everybody agrees. And then finally, the payoff for all this is not just the hopeful 25% per annum return across the entire thing. There are a lot of non-financial rewards, and virtually every angel that I am aware of could make the same more or less money in other ways, or close to it. They could put their money into a venture capital fund and get 20% instead of 25, but with like 99.999% less work. So why the hell do they do this? Because being an angel can be an enormous amount of fun, right? You get to keep up with the world and you see what's going on. You'll often hear about new developments from your company and their competitors and things in the industry before it makes the major press. It's like, being a grandparent. You get all the fun of children without having to change the diapers. So it lets you sort of be an entrepreneur without actually having the responsibility of being an entrepreneur. So sort of the fun parts of entrepreneurship. If you've been a successful founder yourself, and now you're cashing out, you're going back in. This lets you give back and mentor and teach. For Pete and Ryan and me, this is one of the most fun things about this. We love giving back, and if you're the kind of person who enjoys mentoring and supporting, there is nothing warmer in the world than doing that. The other people you'll be investing with, your fellow angel investors, turn out to be actually pretty cool people. If you're an angel investor, that means you probably were successful, highly successful somewhere in some business, typically as an entrepreneur. So they often think like you, and you can make a lot of really interesting friends there. And finally, there are businesses that, in addition to making just straight up money for you, can help change the world. And that's a subset of angel investing called impact investing, right? And so if you think about businesses, the spectrum of businesses goes from traditional businesses that are just out there to make money however they can do it while staying on the right side of the law, right? On the other hand, there are businesses or organizations that are purely charitable. They give money away. The Red Cross doesn't make money. The Red Cross people give money to Red Cross, and the Red Cross gives it away. The interesting thing is that there's a whole range here, and there's a range of businesses, of organizations between those two areas, things that are pure charities and things that are purely commercial businesses. And this group in here that we are sort of social ventures, are things that are doing good for society. This is where impact investors lie. And impact investors invest only typically in companies that are doing good things for society and making money. And so if you get into that area, and we'll have a whole session on impact investing, you have to sort of make a choice. Which of the two is more important to you? They can't be equally important, right? You have to pick, you're either maximizing for your economic return and saying, I'm only going to take a minimum amount of, you have to do at least this much social good while making me a lot of money, or the other way around, you're going to maximize for social good and say, but I got to get at least a return of X, Y, or Z, right? And then you can look at businesses that do those kinds of things. All right, well, we're getting close to the end here. So let me wrap you up with what are the top 10 mistakes that angel investors make when they start doing it, right? Number one, investing in one of the first deals you see. By definition, founders are working as hard as they can to make their deal as attractive as possible and tell you that it's going to change the world and make $1 billion. And in fact, we are working with founders through our mission control problem to help them tell you how wonderful they are, right? And so therefore, if you see a good pitch, really good pitches are amazing. You want to invest in everything you see. But you have to have again, intestinal fortitude and discipline to say, okay, I'm not going to invest in the first deal I see, but let me look at a few so I can begin to calibrate, right? Number two, no matter how sexy it looks, do your diligence. I once saw an amazing company tell stories about all the time that had negative production costs, negative raw material costs, negative marketing costs, negative sales cost. Amazing deal, right? And I ended up not investing because there are things that came out in diligence that didn't really work, but it was a great story over there, right? If you invest in, things like, nanotechnology or quantum computing, and you don't know anything about it, you are just asking, if not to be plucked like a chicken, because most entrepreneurs are actually straightforward, to get in way over your head and lose your cash because you don't have the intelligence background. You're probably smart, but you don't have the knowledge and background to make that kind of decision, right? On the other hand, if you are, you make a decision, this is a good company to invest in, but you're not really an experienced angel and you're not working with other experienced angels or mentors or guides, if you invest at too high a valuation, your company may be successful, but you won't necessarily make a whole lot of money in doing so. And along with that comes the concept of an uncapped safe. We will spend a lot of time talking about the kinds of paperwork and documentation they do. An uncapped safe, which means that when it converts into a different valuation, that makes sense for a friends and family round, when people who aren't sophisticated, but hopefully you will be a sophisticated angel investor, and you will be able to know what the valuation for a company should be. So then if the company presents you documents and says, oh, just sign here and send us a check. No, you don't want to do that. You either want to make sure a lawyer looks at it, or if you're working on a platform like Gust, where we have lots of lawyers who have worked on stuff over here, we can save lawyers money, but nevertheless have legally reviewed stuff because it's standardized. That's a way to do it, right? When you invest in a company, the company will need more money. I've invested in probably 120 companies, and every single one of them needed more money. So therefore, not reserving additional capital for your investment is going to be a problem, because whether it's a good or a bad deal, if it's a down round, but the company has promise and you can't chip in, you may lose your whole investment. If it's an up round and good things are happening, you can't participate because you don't have the cash to do it, right? So you want to try and save some cash to invest in future rounds. You also, as we discussed, want to aim at least 20 companies, right? More is better, up to, some high double digits. Lower gets to be problematic. Lower than 10, you really shouldn't start doing this, right? And then back to the point and place of beginning, I mentioned that this is a long-term play. If you're going to be an angel, you got to commit to holding for a long time. You got to commit to investing repeatedly and steadily for a long time until you've invested the number of companies you're trying to reach. Even if you haven't made money on the first ones, even if which the first companies need more money, you're still going to have to invest to keep your going and keep building your portfolio over there. And then finally, you want to understand and be straight with your founders, and you do not want to drag out the process. Many founders don't take money from angels if they can help it, because angels have gotten a bad reputation for dragging things out, asking for unrealistic terms. And hopefully through Angel Guide, we're going to work with you to make sure you don't do that. Instead, we're going to help you learn how to be a great angel investor. And therefore, I'm going to leave you today with the top 10 experienced angel investor practices that we will go through over the next 3 weeks and the next year with the Angel Guide at Gust. And here's how we're going to help you, right? First of all, you want to see lots and lots and lots of companies. Generate a high quality, high volume deal flow funnel. Remember, you're only looking for like 1 out of 40 companies, but the more companies you see, the more shots on goal you have. And we're going to help you figure out how to get that kind of deal flow and share some of that deal flow with you. Number two, when you're doing due diligence, you want to be able to gather all the information you can. Again, we help through Gust Launch, where we're working with a number of companies. We help build a data room for the company, and we can help walk through and look at what are the most important things I have to understand about that company, and how do I check my diligence, right? When you then have decided, okay, that the company is legit, I've got some great companies in there, you want to select your companies for that home run potential. You want them to be unicorns. We'd love them to be unicorns, right? But on the other hand, if it doesn't get to be a unicorn, can it at least be a gazelle, right? You're not going in it for go moonshot or go home. You're going in it for, I want to have a good company and hopefully a great company. And when you do that, you then want to negotiate reasonable, rational terms. Be fair to everybody. That's the essence of a good relationship between you and the startups in which you're investing. Everybody should be fair. The valuation should be reasonable. And for the reasons I mentioned, founders may not understand why you need 30x and what that means to them, because they think we're only looking for a 3x return. Yeah, but 30x is what you need because of the whole portfolio theory, right? So you got to aim for that 30x, even though founders would love you to say they only want to get 3x out of them, right? Once you've invested, you want to be really helpful to your company. I mean, if the founder wants you to just shut up and go home, okay, you do that. But most founders will be happy to take your support in every way you can. We talked about things you can do to add value there. You want to be proactive, responsive to your founders out there. And then when it comes time to invest and the company needs more money, got to be careful about this one, right? In general, my experience says if it's an up round where the company is valued more and you're getting actually less for your investment than you got the first time, that's actually a good investment, because a company that is doing an up round is typically en route to being many more up rounds. And that's typically a good thing. A company that's having a down round where you get more money for your investment than you did the first time round because the valuation of the company is lower, that can be tricky. It can be tough to recover from that. But on the other hand, if it does, my first big mega angel deal was one of these down rounds where I made 10x my money on that. So you can be very careful and rational as you think through it. Number 8. When it comes time for an exit, that's where you make your money. You don't make any money until somebody else comes in and buys that company. And you want to help the founders negotiate that sale and be a proactive angel to do that. Psychologically, accept the fact that most of your company investments are going to fail, because they do. Most angel investments fail. And you have to accept that psychologically and understand that you're playing a portfolio distribution theory. And at the end of the day, your return is going to come from the mega ones that succeed. And then finally, number 10, after you become a wildly successful angel and you invest in all kinds of companies, you've supported founders, repay it, pay it forward. repay the industry, being a mentor, help support with our mission control program, other new founders coming in, teach, write books, whatever, be a net plus to society. So that's what we're doing. That's what angel investing is all about. That's what the Gust Guide is going to be for 3 weeks starting in June and followed by an entire year of sessions with other angel investors and founders and industry experts. What you see on the screen here is the closing words from my book, Angel Investing. And so angel investing does play a vital role in launching and nurturing businesses that will shape the world tomorrow, companies that will help millions of people live richer, longer, healthier, more prosperous, and more enjoyable lives, even as they build significant assets for their founders, their employees, and yes, their investors. So welcome to Angel Guide. We hope you'll join us on this remarkable journey.
And thank you all for staying late as we started late. We do have 2 questions in the Q&A that I think we can get through relatively quickly. We have put a bunch of links about Angel Guide in the chat, both to learn more at the website and to reach out with more questions. We're really excited about it. It is built on the experience Ryan and I have had over the last 10 years working with David, moving from individual contributors who are invested very, very deeply in one startup to looking towards ways that we can diversify that investment across more startups. So you get to work with folks like us and folks like David, and we're really trying to bridge that gap between folks who are coming at this for the first time and those who are more experienced but are a core part of the Gust ecosystem. So real quick, well, I'll start with the easy one first. What is the exit event for companies that don't IPO but are very successful? How do angel investors get paid?
And the answer is that answers most companies because the number of companies that have IPO'd is virtually zero. The number of my direct investments of 120 companies over probably 35 years at this point that have directly IPO'd is zero. I had an investment in Uber, which actually IPO'd, but that was not a direct investment up front. I had a couple of ways in there. So typically, the typical exit for an angel is by a sale of the company to a larger company. They either buy you out for cash or they buy you out for shares in the larger company, typically a public company, which you can then sell. And so probably 95% of all positive exits from angel deals are by a sale of the company. There are some cases where it turns into a company that didn't hit it out of the park, is not acquired, but is a profitable company and can provide cash over time. But that's typically not what angels are looking for. They're not looking for screwy royalty deals. They're not looking for lifestyle businesses. And so typically it'll be an acquisition by somebody along the way.
Awesome. Thank you. And the other question we have is high-level advice on how to efficiently run an angel investing group. Any best practices or common pitfalls? I will take this one briefly before I hand it over to David, in that you should use a communications and coordinations platform for structured deal intake that allows you to collaborate on it. Gust builds one. By joining us in Angel Guide, you will get access to it for your personal deal pipeline. And some of the key things that we hear from angel groups is that dealing with angels is very much like herding cats. You need to make sure that you are properly directing their attention and energy to the things that you need them to work on at the time. And member engagement is always a big thing that group coordinators are thinking about, and one that we are keeping top of mind as we launch Angel Guide and the underpinning community.
So I will tell you, I just got back literally last evening from Columbus, Ohio, where I spent 3 days at the Angel Capital Association Summit, where angel group leaders from all over the country came together. And the one question they all asked was exactly what you just did. How do I manage to maintain an angel group? And the answer is at Gust, we've been supporting angel groups for literally 20 years. We probably know more about supporting groups of angels than anybody literally in the country, if not the world, because we are a global platform. And, I founded New York Angels. I was chairman for 8 years. It is tough. It is often thankless. It can be fun if you enjoy, if you're a masochist and you enjoy doing this kind of stuff. And there have been lessons learned over enough time. So first of all, having a platform like Gust, which powers a majority of the world's angel investor networks, is really critical. That handles things like deal flow and applications and meeting scheduling and diligence and portfolio stuff and all that kind of thing. So you'll need a platform of some kind. More importantly, we have worked with a bunch of different groups in helping start up their angel groups, and I can personally come down and help you. But typically, to start a group, you'll require at least one or more, hopefully, big name people with big reputations and big checks who are willing to sit there and be, listen, your bell cow, right? They're willing to step up and say, hey, join me as an angel investor. Bill Gates invites you to join him as an angel investor. You'll get everybody who you invite, right? So you need somebody. You can't just start it by staff. You got to start it by somebody who's writing checks. You then need to have a structure, such as provided by Gust and other ones, and understanding how it works. You need to have somebody who's going to do the grunt work, because organizing these cats is insane. Purely volunteer angel groups with no staff have a hard time struggling, because just managing deal flow and assigning things and managing groups and supporting them can be problematic. So you got to find a budget from somewhere. Either you charge your angel investors themselves membership dues. Membership dues for angel groups are typically in the low thousands of dollars a year and don't go to investment. They just go to managing the group. Or you can be supported by an economic development agency or university, or whatever. And then you want to get active deal flow, good deals coming in. You want to make sure that your angels actually volunteer to work and lead deals and grow. You want to continually have angel education things like we're providing here to help people become better angels. You then, once you have a successful exit, that's a wonderful thing to attract other people coming to you. And then you want continuity of both management and at a board level and of angel investors in the group. So we'll be delighted, as the world's primary support organization for angel groups. We would be delighted to help you pull all that together, because that's what we do.
Two more quick things there. Angel Capital Association does publish Angel Box, which is a deep dive PDF style book that walks through all of the different structures you can take. If you want people to help you navigate that without reading 150 pages on it, Angel Guide is a great place to go. And trying to dive deep into how to bring capital together and how to form those relationships and how to help people who are coming to this for the first time figure out how to create a portfolio strategy on a limited budget and how to tie your investments to other investments in the ecosystem and figure all this stuff out. That's exactly what we're going to be doing in Angel Guide. We're pretty excited about it. We hope you'll take a look. Thank you all for being here today. Thank you to everybody who's stayed for the extra time. We will send out a recording and follow-up emails with more info, and we hope to see you again soon.
Thanks, everybody. Thank you very much, David.
My pleasure.
David.
Bye, all.